In this video, we're going to explore multiples-based valuation, including what it is, how it works, and some of the most important things we want to bear in mind. So let's get into it. Ultimately, multiples-based valuation is one of the easiest and most common valuation techniques out there. It's often called relative valuation or comparables-based valuation, or simply comps valuation. And there's a good reason for this, as you'll see in just a bit. Now, multiples-based valuation relies on the use of multiples to determine the price of a security or a stock. Now, what are multiples? Well, they're essentially factors that we use to estimate the value of a security or a stock, or indeed even houses. Multiples are a function or tend to depend on two things, including the stock price and something we call a driver of value. Now, what do we mean by a driver of value? Well, it's something that drives or causes the value to increase. Examples would include things like earnings, i.e. profit, or revenue, aka turnover, as well as book values to an extent. Generally speaking, multiples are ratios, i.e. they tend to be one number divided by another number, although they don't necessarily need to be ratios. For the most part though, we'll be working with multiples as ratios. Since they're typically ratios, we can rearrange these ratios to obtain an expression for the price of a stock. So to give you an example, one of the most popular investor ratios is what we call the price to earnings, or the PE ratio. As the name kind of suggests, it's the price relative to the earnings. So it's the price or the stock price divided by the earnings per share, or the EPS. Now, we're going to discuss the price to earnings ratio in a lot more detail later on, but the only thing you need to know for now is the fact that this is one of the most popular ratios out there, and what we can do essentially is rearrange this equation to gain or to obtain an expression for the price. So what does that look like? Well, we know that the price to earnings ratio, PE, is equal to the price divided by the EPS. If we multiply both sides by the EPS, well, the left-hand side would be the price to earnings, PE, multiplied by EPS, and the right-hand side would be P divided by EPS multiplied by EPS. And so the EPS on the right-hand side would essentially cancel off. So what you'll be left with then is that the price is equal to the price to earnings ratio multiplied by the EPS. And so this is an example of a multiples-based valuation, right? So we're saying the price of a stock P is equal to some multiple, which in this case is the price to earnings ratio, multiplied by a driver of value, which in this case is the earnings per share. Right? So P here is the price of a stock, EPS is the earnings per share, which we're saying is a driver of value, and PE here is just the price to earnings ratio, or the price to earnings multiple. Now, if we were to generalize this to any multiple as opposed to just the price to earnings ratio, and any driver of value as opposed to just the EPS, then we could say that the price of a stock is given by M multiplied by DV, where M is some multiple, aka factor, and DV is some driver of value. And if we were to condense this entire course, and indeed this entire concept of multiples-based valuation, into one single equation, well then this would be it, right? The price of a stock can be obtained by taking some multiple and multiplying it by some driver of value. That being said, this equation is not really clear, and that is because, generally speaking, the multiple that we use is of a comparable firm or comparable firms, rather than the multiple of the firm that we're actually valuing. And this is precisely why multiples-based valuation is also called relative valuation or comparables valuation, because we're coming up with a valuation estimate relative to another firm. Put differently, we're coming up with a valuation for a firm based on the firm's comparables, or based on the comparable firms of our target firm. And so if you wanted to obtain the value for a firm A, you would need to multiply firm B's price to earnings ratio, or indeed any multiple, with firm A's EPS, or indeed some other driver of value. But if we consider just the price to earnings ratio and the EPS, then we can say that the price of a stock A is equal to the price to earnings ratio of stock B multiplied by the EPS of stock A. Obviously, we don't want to just limit this to the price to earnings ratio, So we can generalize this equation and say that the price of any stock J is equal to the multiple of a comparable stock or firm K multiplied by the driver of value of stock J, right? So PJ here refers to the price of a stock J. MK here refers to the multiple of a comparable firm K. So J and K are just sort of generic terms. J could be anything, for instance, Google or Apple or Facebook or Snapchat or Spotify or whatever you like, right? And K would then be a comparable firm of J. So if you think of J as, say, Apple, then you might argue that a comparable firm K would be something like Samsung or perhaps Microsoft, or indeed Alphabet or Google with their Pixel phone and the Android software and so on and so forth. Now, importantly, the comparable firm needs to be as close to the target firm as physically possible. In fact, ideally, it should be identical to the firm that you're trying to value. And so already you might well have realized that if we just look at a simple case like Apple, well, how do we find a comparable firm that is identical to Apple? Perhaps that's impossible, but equally, even finding a firm that's a good or close comparable to Apple is not so easy. And so we're going to spend a lot of time talking about and learning how we can go about finding an appropriate comparable for any target firm. Now, the reason this is so important is because the use of another comparable firm's multiple relies on the law of one price, which in a nutshell says that any two assets with identical risk and rewards must have identical prices. So if you have two stocks that are identical in all aspects, then they must be trading at the same price. Now, this is such an important concept, not just for this course, but for finance as a whole. So I really need to make sure that you understand it. And so I'm going to spend a little bit of time to make sure you really do understand this. So consider two completely identical stocks, Arthur plc and Conan plc. They both have an expected return of 10%. So this means that if you were to invest in Arthur plc, you expect your money to increase by 10%. So if you bought $1,000 of Arthur plc stock, conditional on this being true, you'd expect to earn $100 because that's 10% of your investment. And you expect to earn exactly the same amount by investing in Conan plc because it has the same expected return. Now, the risk of the two stocks is also completely identical at 15%. You don't need to worry about how I got these figures. To be honest, I completely made them up. For now, just assume that this data is true. And further assume that the price of Arthur plc is known to be $100. If all of that is true, how much would you pay for Conan plc? It's a good idea to pause the video right now and try and think about how much you're willing to pay for Conan plc. Hopefully you did that, and what you likely thought was that given that these two stocks are identical and they have exactly the same payoffs, the expected returns, and exactly the same risk, they should be trading at identical prices. In other words, you should be willing to pay no more than $100 for Conan plc because the stocks are completely identical and so their prices must be identical as well. This is ultimately because of the law of one price. If it doesn't hold, so if the prices aren't equal, then an arbitrage opportunity exists. And what that means is that you can earn guaranteed money risk-free with zero investment. It's like everyone's dream. And to see how this would work, consider this scenario. Imagine that Arthur plc was indeed trading at $100, but Conan plc is trading at $110. With this scenario, we can conclude one of two things quite confidently. We can either conclude that Conan plc is overvalued and that the fair price is indeed $100, so Conan plc should be trading at $100, or we can conclude that Arthur plc is undervalued and that the fair price is actually $110, and so Arthur plc should be trading at $110. Obviously, because we don't have any other information, we can't say which is the right price, but what we can say is that the two prices must be equal, and if they're not, then an arbitrage opportunity exists. And so rational investors would either go long, which is a fancy word for essentially saying they would buy stocks in Arthur plc at $100, or they would short, which is a fancy word for sell, stocks in Conan plc at $110. Now they might do both, which is a process called hedging, which is likely the optimal thing to do because we don't know which is the correct price or the fair price. And so the best bet in this scenario would be to hedge. So you would buy Arthur PLC and you would short Conan PLC, and the likely result would be that the fair price would probably be somewhere in between, maybe $105. But I don't know. And it's not necessarily that, because like I said, the fair price could be $110 or it could be $100. The point is that if you have two identical stocks with different price points, then an arbitrage opportunity exists. There's a mispricing in place, and so there's money to be made. Now, if you're wondering what short selling is, no need to wonder. There is another video, and we will go over the concept of short selling later on. For now, all you need to know is that short selling allows investors to make money when stock prices decrease. Completely opposite to going long or buying stocks, wherein you would only make money if the stock price increased. But more on that in a later video. For now, let's think about what would happen if rational investors did indeed buy Arthur PLC and short Conan PLC. This influx of demand and supply would cause the prices to change. And so ultimately what would happen is that both stock prices will converge. They'll trade at exactly the same price. And again, because we don't know which is the fair price, there's now two possibilities. The price will either be $100 for both stocks, or it'll be $110 for both stocks, but you won't have a situation where one trades at $100 and the other trades at something else, because that would violate the law of one price. An arbitrage opportunity would emerge, and investors, or what we call arbitrageurs, would exploit this arbitrage opportunity by buying the stock that's priced lower and short selling the stock that's priced higher, and then the resulting demand and supply would cause the prices to change, and ultimately you'd have a price convergence. Alright, hopefully that makes sense. Now importantly, in the real world, it's extremely difficult and perhaps impossible to find two perfectly identical stocks. Having said that, with a solid foundation and a good, robust system, it is possible to find two incredibly similar stocks. And that's exactly what we're going to learn how to do later on in the course. For now, just a quick summary. We learned that multiples-based valuation, aka relative valuation or comparables valuation or comps valuation, is one of the easiest and most common valuation techniques out there. Perhaps most importantly, it relies on the law of one price, which says that any two assets that have identical risks and rewards must have identical prices, failing which an arbitrage opportunity exists, and so rational investors or arbitrageurs would exploit this opportunity until the prices ultimately do converge. Furthermore, we learnt that multiples are essentially factors, or typically ratios, which we use to estimate the value for stock by essentially rearranging it to gain or obtain an expression for the price. So in a nutshell, we can estimate the price of a stock J by multiplying its driver of value by a multiple of a comparable stock K. Alright, that's enough from me for now. Have a go at the quiz, and I'll see you in the next video.